Somewhere right now, there's a number attached to your name. You didn't choose it. You weren't asked about it. You may not even know exactly what it is at this precise moment. But this number, 3 digits, somewhere between 300 and 850, and is quietly running your financial life in ways that go far beyond what most people realize. It determines whether you get approved for an apartment. It determines the interest rate on your car loan, your mortgage, your credit cards. It affects your insurance premiums in most states. It can influence whether you get a job offer in certain industries. It determines how much you pay for essentially everything you finance over the course of your life. And the difference between a good score and a great score on something like a 30-year mortgage can amount to tens of thousands of dollars, sometimes hundreds of thousands, and yet most people's understanding of how this number works is somewhere between pay your bills on time and I think closing credit cards is bad, which is roughly equivalent to understanding how a car works, because you know it needs gas and you probably shouldn't drive it into a lake. The credit score system is not complicated, but it is deliberately opaque. The companies that calculate your score, is primarily FICO and VantageScore, are private companies selling a product to lenders, not consumer advocates. The banks that use your score have financial incentives that don't always align with yours, and the personal finance industry has done an admirable job of producing generic advice that keeps people from understanding how the system actually works well enough to use it to their advantage. This video is going to change that. We are going to go deep. Not check your score for free on Credit Karma Deep, but actually deep. We're going to talk about what credit scores actually measure and what they don't. We're going to talk about the specific mechanics of each scoring factor, including the ones that get glossed over. We're going to talk about legal, legitimate strategies that move your score significantly faster than the standard advice suggests. We're going to talk about what your bank actually does with your score, and why their incentive structure is not what you think it is. And we're going to talk about the advanced moves that people with scores above 800 actually use, which it turns out are neither mysterious nor complicated, just rarely explained clearly. By the end of this video, you will understand your credit score better than most bankers do. Not because bankers are stupid, but because their job is to use your score, not to explain it to you. Your job, starting now, is to understand it well enough to optimize it, because the financial benefits of doing so are enormous, and most people are leaving them completely on the table. Let's get into it. Chapter 1. What a credit score actually is, and why the official explanation is incomplete. The official explanation of a credit score goes something like this. It's a 3-digit number that represents your creditworthiness, how likely you are to repay debt. Lenders use it to decide whether to approve your application and at what interest rate. Higher is better. It's calculated based on your credit history. Pay your bills on time and it goes up. That explanation is not wrong. It's just so incomplete that it might as well be. Here's what the official explanation leaves out. Credit scores are a product, not a public service. The most important thing to understand about credit scores, the thing that reframes everything else, is that they are a commercial product created by private companies and sold to lenders. FICO, which produces the dominant scoring model, is a publicly traded company called Fair Isaac Corporation. VantageScore, the other major model, was created by a consortium of the 3 major credit bureaus, Equifax, Experian, and TransUnion, also for commercial purposes. These companies are not government agencies. They have no legal obligation to make their scoring models easy for consumers to understand. They have no mandate to design their systems in ways that help people improve their scores. Their customers are lenders, banks, credit card companies, auto lenders, mortgage companies, not you. You are, in a somewhat uncomfortable sense, the product being evaluated, not the customer being served. This matters because it explains the opacity. The specific formula FICO uses to calculate your score is proprietary. The exact weights applied to each factor are not fully disclosed. The reason for this is competitive. FICO doesn't want competitors reverse engineering their model, but the effect is that consumers are being evaluated by a system they can't fully see, for the benefit of institutions whose interests don't always align with theirs. Understanding this doesn't make the system go away, but it does mean you should approach credit score optimization not as a cooperative exercise with institutions that want to help you, but as a strategic exercise of understanding a system well enough to work within it effectively. The system has rules. The rules can be understood, and once they're understood, they can be worked legally, legitimately, and significantly to your advantage. There is no single credit score. Here's the second thing the official explanation glosses over: you don't have a credit score. You have dozens of them. FICO alone has produced over 50 different scoring models. There are base FICO scores, FICO 8, FICO 9, FICO 10, FICO 10T, and industry-specific scores for mortgage lending, auto lending, and credit card lending. Each model weighs factors slightly differently and produces a different number. Your FICO auto score used by car lenders is a different number than your FICO mortgage score used by home lenders. Your FICO 8 score, the most commonly used general model, is different from your FICO 9, which treats medical collections differently. Vantage Score has its own suite of models, Vantage Score 3.0 and 4.0 being the most current. These scores use the same underlying credit data but calculate the number differently. A person with a FICO 8 of 720 might have a Vantage Score 3.0 of 740 or 695. Neither is more real than the other. They're just different models evaluating the same information differently. Beyond that, your score is different at each of the three major credit bureaus: Equifax, Experian, and TransUnion, because each bureau may have slightly different information about your credit history. Not all lenders report to all three bureaus. Not all accounts appear on all three reports, so your Equifax FICO 8 might be 718, your Experian FICO 8 might be 724, and your TransUnion FICO 8 might be 711. Three different numbers, all technically accurate, all based on the same model applied to slightly different data sets. The practical implication: when you see your credit score on a free monitoring app, you're seeing one specific score from one specific model at one specific bureau. That number is useful for tracking trends, but it is not necessarily the score your lender will pull when you apply for something. Mortgage lenders, for example, typically pull all three bureau scores and use the middle one. Auto lenders often use a specific FICO auto score that you may never see on a free monitoring service. This is not a conspiracy. It's just a fragmented commercial ecosystem that never prioritized consumer clarity. Knowing it exists prevents the confusion of seeing your score drop on one app while it rises on another, or applying for a mortgage and being surprised that the lender is quoting you a score that's different from the one you've been tracking. What a credit score actually predicts. The official description says credit scores measure creditworthiness, how likely you are to repay debt. More specifically, FICO scores are designed to predict the probability that a borrower will become 90 or more days past due on any account within the next 24 months. Read that again. Credit scores are not measuring how financially responsible you are in a general sense. They're not measuring your wealth, your income, your savings, your net worth, or your overall financial health. They're measuring one very specific thing: the statistical probability that you'll miss payments on debt in the near-term future. That's it. This has some interesting implications. A person with a high income, significant investments, and strong overall financial health can have a mediocre credit score if their credit file is thin or their credit utilization is high. A person with a modest income who has strategically managed credit accounts over many years can have an excellent score. The score is measuring credit behavior, not financial health, and those are meaningfully different things. It also means the system has some structural quirks. Having no debt isn't the same as having excellent credit. In fact, having no credit history produces a lower score than having actively managed credit accounts because the scoring model doesn't have data to evaluate. Being rich doesn't help your score if you never use credit. Being a good saver doesn't help your score at all. The score is specifically measuring credit behavior, and you have to play the game on its own terms to optimize it. The three credit bureaus, not as reliable as you think. Before we get into the scoring factors, there's one more foundational piece to understand. The credit reporting system that feeds into your score is remarkably error-prone. Studies consistently find that a significant percentage of credit reports contain errors, sometimes minor, sometimes significant. The Federal Trade Commission has found that approximately 1 in 5 consumers had an error on at least one of Their 3 credit reports, and about 1 in 20, had errors serious enough to result in a higher interest rate than they deserved. These aren't theoretical errors. They're accounts that don't belong to you. Payments marked late when they were made on time, balances reported incorrectly, accounts that weren't closed when you closed them, and occasionally, identity theft that's been sitting on your report for years without your knowledge. Checking your credit reports, all 3 of them from all 3 bureaus, is not optional if you care about your score. It's the foundational step before any optimization strategy, because you can be executing every other strategy perfectly and still have your score artificially suppressed by an error you don't know about. The official channel for free credit reports is annualcreditreport.com, where you're entitled to free reports from all 3 bureaus. Review them. Look for accounts you don't recognize. Look for late payments on accounts where you have confirmation you paid on time. Look for balances that don't match your records. Look for accounts that show as open when you know they were closed. Dispute any errors directly with the bureau reporting them. The process is bureaucratic and sometimes slow, but it's free and it can produce meaningful score improvements from correcting information that was never accurate in the first place. Chapter 2. The 5 factors. And the 2 nobody talks about FICO scores are calculated from 5 categories of information, each weighted differently. You've probably seen the list before: payment history, amounts owed, length of credit history, new credit, and credit mix. These are the official categories, disclosed publicly. What doesn't get disclosed publicly, and what most credit score articles repeat without examining, is how these categories actually work in practice, including the specific mechanics within each category that most people don't understand. Let's go through all 5 with the depth they deserve. Factor 1. Payment. History. 35% of your score payment history is the largest single factor in your FICO score, which makes sense given what the score is trying to predict. If it's predicting your probability of missing future payments, your history of past payments is obviously highly relevant information. But the mechanics within payment history are more nuanced than pay on time. First, not all late payments are created equal. A payment that is 30 days late is significantly less damaging than one that is 60 days late, which is significantly less damaging than 90 days, which is less damaging than 120 days. The scoring model is sensitive to the severity of delinquency, not just the presence of it. If you've made a payment 29 days late, technically overdue, it doesn't appear on your credit report as a late payment at all, because credit bureaus don't typically report lateness until it reaches the 30-day threshold. This is not an invitation to regularly pay 29 days late. Your creditor may charge a late fee and the relationship deteriorates, but it does mean that a payment you're a few days late on is not a credit report event. Second, recency matters enormously. A late payment from 6 years ago matters far less to your score than a late payment from 6 months ago. The scoring model weights recent behavior more heavily than historical behavior, which means that a single late payment, even a significant one, loses its scoring impact gradually over time as you build a subsequent history of on-time payments. This is important for people who had financial difficulties in the past. The damage is not permanent. It fades. The recovery timeline depends on the severity of the negative item and your subsequent behavior. Third, a single late payment won't destroy your score, but it will hurt, and the hurt is disproportionate at higher score levels. If your score is 620 and you have a late payment, the damage is meaningful, but the score was already reflecting credit challenges. If your score is 780 and you have a single 30-day late payment, the damage can be 60 to 110 points, because the model is adjusting for the unexpected deviation from a previously pristine record. The better your score, the more a single negative event hurts. This is cruel but logical from a statistical prediction standpoint. Fourth, and this is the one almost nobody talks about, goodwill adjustments are real and more effective than people realize. If you have a previously clean payment history and you have one late payment, typically due to a genuine oversight, a billing address change, a hardship, or a bank error, you can call your creditor and request a goodwill adjustment, essentially asking them to remove the late payment notation from your credit report as an act of goodwill, given your otherwise strong record. This works with surprising frequency. Not always. Not with every creditor. Not for serial late payers, but for someone with a clean history who missed one payment and can make a polite, honest request, in writing or by phone, Creditors regularly grant goodwill adjustments. They are under no obligation to do so, but many do, both because it's good customer service and because keeping a good customer happy has business value. This is not a trick or a loophole. It's a legitimate ask that the credit system allows and that most people don't know they can make. Factor 2. Amounts owed. 30% of your score. The second factor is the most misunderstood one, and the one with the most immediately actionable optimization strategies. Amounts owed sounds like it refers to your total debt load, how much money you owe in aggregate. And that's not quite right. What the model is actually most concerned about here is your credit utilization ratio, the percentage of your available revolving credit that you're currently using. Revolving credit means credit cards and lines of credit, accounts where you have a credit limit and can carry a balance. Installment loans, mortgages, car loans, student loans are treated differently and have a less significant impact on this factor. Your utilization ratio is calculated both in aggregate and per card. If you have 3 credit cards with a combined limit of $20,000 and you're carrying a combined balance of $8,000, your aggregate utilization is 40%. But if one card has a $5,000 limit and a $4,500 balance, 90% utilization on that card's individual utilization is also damaging your score even if your aggregate is technically moderate. The standard advice you'll hear is to keep utilization below 30%. That threshold isn't wrong, but it's significantly more conservative than optimal. Scoring research consistently finds that people with the highest scores typically carry utilization below 10%, and some studies suggest that single-digit utilization, particularly in the 1% to 6% range, is associated with the best outcomes. Not zero, more on that in Chapter 3, but very low. Here's the critical mechanic that most people miss. Utilization is calculated at the moment your statement closes, not at the moment you pay the bill. Your credit card issuer reports your balance to the credit bureaus once a month, typically at or around your statement closing date. Whatever balance appears on that statement is what gets reported. If you pay your bill in full every month but you're making purchases throughout the month and your statement closes with a high balance, your utilization is high even though you're paying it off completely. You're technically a responsible card user and the score is temporarily penalizing you for it. This is both the problem and the solution. Because utilization is reported at statement close and not at payment, you can time your payments, paying down your balance before the statement closes rather than after to report a lower utilization. This is legal, this is available to anyone, and it can produce meaningful score improvements within a single billing cycle. We'll get deeper into the mechanics in Chapter 5. Factor 3. Length of credit history. 15% of your score. Credit history length is the factor that feels most unfair to young people and recent immigrants. The longer your credit accounts have been open, the better for your score. The model looks at the age of your oldest account, the age of your newest account, and the average age of all accounts. The implication that causes the most unnecessary damage is the belief that closing old credit cards is harmless or even beneficial. It is neither. Closing an old credit card can hurt your score in 2 ways. It can reduce your total available credit, increasing your utilization ratio, and depending on how your credit history is calculated, it can affect the average age of accounts. An old card with no annual fee and no activity is generally worth keeping open. The history it represents is contributing positively to your score at 0 ongoing cost. What's less appreciated, new accounts lower your average account age, which is one of the reasons to be thoughtful about opening new credit. Every new account dings your average age, and the effect is more pronounced when your credit file is thin and your average age is already low. Factor 4. New credit. 10% of your score. New credit covers 2 things. Hard inquiries, when a lender pulls your credit as part of an application, and recently opened accounts. Both have a modest, negative short-term effect on your score. Hard inquiries typically reduce your score by a few points and remain on your report for 2 years, though their scoring impact diminishes significantly after about a year. For most people, the impact of a single hard inquiry is minor, 3 to 5 points, and temporary. The more important mechanic here is rate shopping. Protection. When you're shopping for a mortgage, auto loan, or student loan, multiple inquiries within a short window, typically 14 to 45 days depending on the scoring model, are treated as a single inquiry. The logic is that shopping around for the best rate on a single loan is financially responsible behavior that the model shouldn't penalize. If you're getting quotes from 5 mortgage lenders in a 2-week period, your score is not dinged 5 times. It's dinged once, or close to it. This is specifically for installment loan rate shopping. Credit card applications do not receive this treatment. Each credit card application generates a separate inquiry that's counted separately. Factor 5. Credit mix. 10% of your score credit mix refers to the variety of credit account types in your file: revolving accounts, credit cards, lines of credit, installment loans, mortgage, auto, student, personal loans, and occasionally other account types. Having a mix of both, revolving and installment credit, is marginally better than having only one type. This is the factor that matters least in practice and generates the most confusing advice. Some people interpret it as meaning they should take out a loan they don't need to improve their credit mix. That is backwards. The interest cost of an unnecessary loan far exceeds any scoring benefit. Credit mix is a minor factor that improves naturally as you use credit over time. It's not worth engineering directly. The 2 factors nobody talks about. Here's where we get into the territory the standard 5-factor breakdown glosses over. Within those 5 categories, there are specific patterns and data points that the scoring model weighs in ways that the official categories don't fully reveal. The first is what scoring researchers sometimes call derogatory marks granularity, the difference between types of negative information and how they're weighted. Most people know that bankruptcies, foreclosures, and collections are damaging. What fewer people know is the hierarchy. A Chapter 7. Bankruptcy is more damaging than a Chapter 13 bankruptcy. A mortgage foreclosure is treated more severely than other delinquencies. A collection account that's been paid is treated differently under different FICO models. FICO 9 ignores paid collections entirely, while FICO 8 still penalizes them, which is why knowing which model your lender uses matters when you're deciding whether to pay off an old collection. The second underappreciated element is what some scoring analysts call thin file penalties, the way the scoring model handles insufficient data. If you have fewer than 3 active credit accounts, or a credit history shorter than a couple of years, the model doesn't have enough information to generate a reliable prediction, and the resulting score reflects that uncertainty. Thin file scores are often surprisingly low, not because the person has done anything wrong, but because the model is essentially saying, I don't have enough data to trust this person with credit, which is circular logic that particularly harms people who are new to credit or who have avoided debt for philosophical reasons. The solution to the thin file problem is not to take on unnecessary debt. It's to strategically introduce the right types of accounts. We'll cover this in Chapter 7, to give the model the data it needs to evaluate you accurately rather than conservatively. Chapter 3. The tricks. Inside the tricks. How the scoring system can be legally gamed. The word gaming sounds vaguely nefarious, so let's be precise about what we mean. We are talking about understanding the specific rules of the scoring system well enough to make decisions that optimize your score within those rules, without misrepresentation or fraud. This is no different from a tax professional understanding the tax code well enough to minimize a client's liability through legitimate deductions. The rules exist. The rules can be understood. Understanding them is not cheating. With that framing established, let's talk about the specific mechanics that the scoring system uses and how to work with them. The utilization timing strategy. We introduced this in Chapter 2, but it deserves a full explanation here because it's one of the most powerful short-term score levers available, and it's completely invisible to most people. The mechanism, your credit card issuer reports your balance to the credit bureaus at or around your statement closing date each month. The balance reported on that date is your reported balance for scoring purposes. Your utilization ratio is calculated using this reported balance, not your actual current balance. The strategy, pay down your credit card balance before the statement closes, not just before the payment due date. These are 2 different dates. The statement closing date is when your billing cycle ends and your statement is generated, typically 3 weeks before your payment due date. The payment due date is when the minimum payment is required. Standard behavior, make purchases throughout the month, statement closes with whatever balance you've accumulated, that balance gets reported to the bureaus, you pay the bill by the due date. Result, Your reported utilization reflects your full month of spending. Optimized behavior. Make purchases throughout the month. Pay down the balance before the statement closes. Statement closes with a low or zero balance. Low balance gets reported to the bureaus. You pay the remaining small balance by the due date. Result: your reported utilization is low, your score benefits, and your actual spending hasn't changed at all. For people whose scores are being suppressed by high utilization despite paying their bills responsibly, this single adjustment can produce a score improvement of 20 to 50 points within one billing cycle. The effect is not permanent. You have to maintain the behavior, but it's immediate and real. A note on zero utilization: some scoring experts recommend reporting exactly zero balance rather than a very low balance. The research here is somewhat mixed. Most evidence suggests that 1% to 6% utilization produces the best score outcomes, slightly better than zero, possibly because zero utilization on revolving accounts suggests the accounts aren't being actively used. The practical difference is small, and either very low or zero is dramatically better than 30%, 40%, or higher. The credit limit increase strategy. Here's a lever that works with utilization from the other direction. Instead of reducing your balance, you increase your credit limit. If you carry a $2,000 balance on a card with a $5,000 limit, your utilization is 40%. If you increase the limit to $10,000 while keeping the same balance, utilization drops to 20%. The debt hasn't changed, the available credit has, and utilization is a ratio. Most credit card issuers allow you to request a credit limit increase, either through their website, app, or by calling customer service. The process typically involves either a soft pull, which doesn't affect your score, or a hard pull, which has a minor temporary effect. Many issuers perform automatic limit increases for customers with good payment history. If you've never received one and you've had the card a year or more, it may be worth requesting. The strategy becomes more powerful when combined with the utilization timing approach. High credit limits plus low reported balances equals very low utilization equals a meaningful score boost. One caveat: requesting a credit limit increase right before applying for a major loan, a mortgage for example, requires consideration of whether the inquiry generated by the increase request is worth the timing. The inquiry has a minor negative effect, while the utilization improvement has a positive effect. In most cases, for people who are a few months out from a major application, the net effect is positive. But close to the application date, it's worth weighing carefully. The authorized user strategy. This is one of the oldest and most effective credit-building strategies, and it works because of a quirk in how the FICO scoring model handles authorized users on credit card accounts. When someone adds you as an authorized user on their credit card account, that account, including its full history, typically appears on your credit report. You don't need to use the card. You don't even need to have the physical card. The account history, the credit limit, and the age of the account all contribute to your credit file as if it were your own account. If a family member or trusted friend has an old credit card with a long history, high credit limit, and perfect payment record, being added as an authorized user on that account can meaningfully improve your score, sometimes dramatically, if your file is thin or if the authorized user account significantly improves your average account age or total available credit. This strategy has been controversial because it can be misused. There are rent-a-trade line services where strangers pay to be added as authorized users on accounts they have no relationship to, purely for score manipulation purposes. FICO has made attempts to reduce the impact of obviously artificial authorized user relationships in more recent models, though the strategy remains effective for genuine family relationships and is completely legal. The requirements for this to work: the primary account holder must have a good history on the account, no late payments, reasonable utilization. The card issuer must report authorized users to the credit bureaus, most major issuers do, and ideally, the account should be old with a high limit. Adding yourself as an authorized user on a new card with a small limit and a spotty history provides little benefit. The rapid rescore. Here's one that most consumers have never heard of, because it's technically a tool used by mortgage brokers and lenders rather than directly by consumers. But knowing it exists and knowing how to request it can be genuinely useful. Rapid Rescore is a service offered through the credit bureaus that allows a lender to submit documentation of recent account changes, a paid collection, a reduced balance, a corrected error. and have those changes reflected in an updated credit score within a few business days rather than waiting the standard 30 to 60 days for the regular update cycle. As a consumer, you can't directly request a rapid rescore. It has to be initiated by a lender working with the bureaus. But if you're in the process of applying for a mortgage and there's a recent positive change to your credit, you just paid off a high balance card, you just resolved a collection account, the lender just corrected an error on your report, you can ask your mortgage broker or loan officer if they offer rapid rescore service. Many mortgage-focused lenders do, because helping a borderline borrower qualify for a loan is in their financial interest too. The cost is typically passed to the consumer, often $25 to $50 per account per bureau, but the potential benefit of qualifying for a better rate or a larger loan can far exceed the cost. The strategic new account approach. Opening new credit accounts always generates a hard inquiry and temporarily lowers your average account age, both of which have a modest negative impact on your score. But opening the right new accounts at the right time can produce net positive effects by increasing your total available credit and improving your credit mix. The strategic framework. Open new accounts when you don't need them urgently, not when you're about to apply for something important. The short-term negative effects of a new account, the inquiry, the average age reduction, dissipate within 6 to 12 months. The long-term positive effects, the additional available credit, the growing history, the improving credit mix, compound over time. For someone with a thin file, strategically opening 2 or 3 accounts over 12 to 18 months, a secured card first, then a basic unsecured card, then perhaps a credit builder loan, gives the scoring model the data it needs to generate an accurate, favorable score much faster than waiting for the same thing to happen passively. For someone with an established file who wants to improve their score, opening a new card primarily for the credit limit increase and the utilization improvement it enables is a legitimate strategy, provided the new account's inquiry and age effects don't matter in the near term. The balance transfer consideration. Balance transfers, moving high-interest credit card debt to a new card with a low or zero introductory rate, are primarily a debt management strategy, but they have credit score implications worth understanding. When you open a new balance transfer card, you get a hard inquiry and a new account, but you also get a new credit limit, which increases your total available credit. If you transfer a balance from an old card to the new one, the old card's utilization drops, ideally to zero, and the new card starts with whatever utilization your transferred balance represents relative to its limit. The net scoring effect depends on the specifics. If the new card has a high enough limit that your transferred balance represents low utilization, and if you don't close the old card, leaving its limit contributing to your total available credit, the balance transfer can be mildly score positive or neutral, while potentially saving you significant money in interest. The key is not closing the old card after the transfer, because that card's limit is now unencumbered and is contributing positively to your utilization. To ratio. The dispute and correction pipeline. We mentioned credit report errors in Chapter 1. Here we want to go deeper into the mechanics of disputing errors, because the process matters, and most people do it less effectively than they could. The official dispute process. You identify an error on your credit report, submit a dispute to the bureau reporting it, Equifax, Experian, or TransUnion. The bureau investigates by contacting the data furnisher, the creditor who reported the information. The data furnisher either confirms, corrects, or fails to respond within the required window, typically 30 days, and the bureau updates the report accordingly. That's the official version. Here's what actually maximizes your success rate. First, dispute with the bureau and simultaneously notify the data furnisher directly. The Fair Credit Reporting Act gives you the right to dispute information with both the bureau and the original source. Contacting both simultaneously creates 2 parallel resolution processes and increases the pressure on the data furnisher to respond. Second, dispute in writing and send via certified mail when dealing with significant errors. Written disputes create a paper trail and are legally stronger than online disputes if you eventually need to escalate. Certified mail proves delivery. Third, if a legitimate dispute is rejected, if the Bureau investigates and upholds an error that you know to be incorrect, you have escalation options. You can add a consumer statement to your credit report up to 100 words explaining the dispute. You can file a complaint with the Consumer Financial Protection Bureau. You can consult a consumer protection attorney. The FCRA provides for legal remedies, including attorney fees, when bureaus fail to correct demonstrably false information. Fourth, be aware that the removal of a negative item through successful dispute produces an immediate scoring effect at the next update cycle. There's no gradual phasing in. The item is either there or it isn't. A successful dispute that removes a significant derogatory mark can produce a score jump that would otherwise take years of good behavior to achieve. Chapter 4. What your bank actually does with your score and why they love it when it's mediocre. Let's talk about your bank for a moment. Not in the abstract institutional sense, in the very specific, financially motivated, incentive-driven sense of an organization that makes money from you in ways that are carefully designed to not be immediately obvious. Your bank likes you. Genuinely. You're a customer. You generate revenue. They want to keep you. But the nature of how they make money from you is directly relevant to understanding why the credit score system works the way it does, why certain information never seems to make it into the materials they give you, and why your bank's advice and advice that's actually in your best interest are not always the same. Document. This chapter is about the financial machinery behind credit scoring, what lenders actually do with your score, how they profit from different score ranges, and why the system is specifically structured in ways that benefit institutions more than individuals at the margins where most people live, the risk-based pricing machine. The foundational concept you need to understand is risk-based pricing. Before risk-based pricing became standard, roughly in the 1990s, as credit scoring became more sophisticated, lending was largely binary. You either qualified for a loan at the standard rate, or you didn't qualify at all. The interest rate was essentially fixed for a given product, and the lender's job was simply to approve or reject applicants based on whether they met a creditworthiness threshold. Risk-based pricing changed everything. Instead of a binary approve, chown, or reject decision, lenders now use your credit score to place you in a risk tier that determines not just whether you're approved, but what interest rate you're offered. Higher risk, lower score means a higher rate. Lower risk, higher score means a lower rate. The rate scales continuously with perceived risk, and the spread between the best rate and the worst rate on the same product can be enormous. On a credit card, the difference between an excellent credit rate and a fair credit rate can be 15 percentage points or more. On an auto loan, it can be 10 to 15 points. On a mortgage, the spread is smaller in percentage terms but enormous in dollar terms given the loan size. A single percentage point on a $400,000 30-year mortgage is roughly $90,000 in additional interest over the life of the loan. Here's the part that makes this interesting from a bank incentive standpoint. The most profitable customers are not the ones with the best credit scores. The customers with 800+ scores pay off their balances, rarely carry debt long-term, qualify for the lowest rates, and generate relatively thin margins. The customers with the worst scores often default, which creates losses. The most profitable segment, from a lending institution's perspective, sits in the middle. People with scores in the 580 to 680 range who qualify for credit, carry balances, pay reliably enough not to default frequently, but pay interest rates that are high enough to generate significant margin. These customers are the engine of credit card company profitability. They're the ones most likely to carry a balance month to month, pay the minimum or close to it, and generate years of high interest revenue. This is not a conspiracy, it's just a profit structure, but it does explain why the financial advice that flows most heavily from banks and credit card companies is not always oriented toward helping you get to the 800+ tier as quickly as possible. An 800 credit score customer who pays their balance in full every month is a much less profitable customer than a 640. Credit score customer who carries a $3,000 balance indefinitely, the minimum payment trap engineered by design. Speaking of minimum payments, the minimum payment structure on credit cards is one of the most elegantly engineered wealth extraction mechanisms in modern consumer finance, and it connects directly to the credit score system in ways that are worth understanding. Minimum payments are calculated to be just large enough to keep the account in good standing, avoiding late fees and negative credit reporting, while being small enough that paying only the minimum results in decades of interest accumulation on a sustained balance. The typical minimum payment formula is either a flat dollar amount, often $25 to $35, or a small percentage of the balance, often 1% to 2% plus interest and fees, whichever is greater. on a $5,000 credit card balance at 22% interest. Paying only the minimum payment keeps the account current, no late marks, no credit damage, while extending the payoff timeline to approximately 15 years and generating roughly $6,800 in interest. You pay back the original $5,000 plus an additional $6,800 in interest over 15 years while maintaining a perfectly clean payment history. The credit score system records this as responsible behavior. You're making payments on time. The score improves. The lender is collecting interest for 15 years. Everyone wins, except you, in the most financially significant way imaginable. The minimum payment is calibrated precisely to the threshold of credit reporting. It's enough to avoid a negative mark. It's not enough to make meaningful progress on the balance. And because the credit score system rewards on-time payment regardless of the amount paid, there's no scoring incentive built into the system to pay more than the minimum. The incentive to pay more has to come from you externally through the understanding that on-time minimum payments on a high balance card is the most expensive form of financial responsibility available. How lenders actually pull and use your score. When you apply for credit, the lender pulls your credit report and score. This is the hard inquiry we discussed earlier. But the specifics of how they use that score vary significantly by lender type and product, and understanding the specifics helps you prepare more effectively. Mortgage lenders, as mentioned, typically pull all three bureau scores and use the middle score of the primary borrower. If you're applying jointly, they pull both borrowers' scores and use the lower of the two middle scores. This is why improving the lower scoring partner's credit before a joint mortgage application can have significant impact. Even a modest improvement in the lower score can shift the rate tier. Auto lenders often use FICO auto scores, which are industry-specific models that weight certain factors differently from the base FICO model. These scores place additional emphasis on prior auto loan payment history. If you've had an auto loan before and paid it reliably, your FICO auto score may be higher than your general FICO score. If you've had auto loan problems specifically, it may be lower. Credit card issuers typically use base FICO scores or Vantage scores, often supplemented by their own internal scoring models that incorporate additional data, your banking history with them, how long you've been a customer, your income, which you typically self-report on applications, and proprietary behavioral data they've accumulated. What this means practically, there is no single credit score to beat. Different applications are evaluated with different scores at different bureaus. When you're preparing for a major credit application, it's worth knowing which score model the lender typically uses. You can ask directly or research the lender's standard practices, and focusing your optimization efforts on the factors that most affect that specific model. The soft pull economy. Here's something about modern credit that most consumers don't fully appreciate. You are being credit checked constantly by institutions you've never applied to, and it's completely legal. Soft pulls, credit inquiries that don't affect your score, are conducted by credit card companies, auto lenders, mortgage companies, and other financial institutions on a massive scale for marketing purposes. When you receive a pre-approved credit card offer in the mail, that offer was generated because the issuer conducted a soft pull on your credit, determined that you meet their basic criteria, and targeted you for a marketing solicitation. You never applied for anything. The inquiry doesn't show up on your report in the way hard inquiries do, but they've looked at your credit file. This soft pull marketing economy is why people with good credit receive more and better pre-approved offers. The issuers are identifying you as a desirable customer based on your credit profile and competing for your business. Understanding this inverts the relationship slightly. Instead of you applying and hoping to be approved, you can evaluate competing offers that have already pre-screened you and choose the one with the best terms. The pre-approval offers that come through mail or email are genuinely worth reading if you're in the market for a new credit card or if you're considering a balance transfer. These offers are often better than what you'd get by applying cold, because the issuer has already decided they want you and is competing for your account. The rate, the signing bonus, and the terms in a pre-approval offer reflect the issuer's genuine interest in acquiring you as a customer, which gives you slight leverage. The credit score industry's own conflicts of interest. Let's take a brief detour into the credit score industry itself, because the conflicts of interest here are illuminating. The three major credit bureaus, Equifax, Experian, and TransUnion, collect credit information reported by lenders, compile it into credit files, and sell access to those files and derived products, like credit scores, to anyone willing to pay for them. Their primary customers are lenders. A secondary and growing revenue stream is selling credit monitoring and identity protection services directly to consumers. Here's the conflict. The bureaus collect the data used to evaluate you, sell that evaluation to lenders who make decisions about you, and also sell you subscription services to monitor the evaluation they're performing. They are simultaneously the compiler of your data, the evaluator of your creditworthiness, and the vendor of the product that lets you watch them evaluate you. That's a remarkably vertically integrated conflict of interest that most people haven't thought clearly about. It's not illegal, it's just worth naming because it explains why the free credit score you get from Experian's own website comes packaged with an invitation to subscribe to their premium monitoring service. The free score is a customer acquisition tool. The score itself is a byproduct of their core business. You're being served a limited version of the product they sell to lenders, alongside an invitation to pay for more of it by the same company that compiled the information the product is based on. None of this means the scores are inaccurate or that the monitoring services are worthless, but it does mean you should understand the commercial ecosystem you're operating in when you interact with any of these services. What banks want you to believe about your score. Let's get specific about the advice that benefits your bank more than it benefits you, advice that gets repeated so often in bank-produced financial education materials that it's become conventional wisdom. Close credit cards you don't use. As we discussed, closing old cards reduces your available credit, increases your utilization ratio, and can affect your average account age. This advice benefits banks in a roundabout way. Fewer open lines of credit means higher utilization on remaining cards, which means a slightly lower score, which means a slightly higher rate tier on your next loan application. The bank hasn't done anything to you, but the advice, if followed, works against your credit score in several ways simultaneously. Only apply for credit when you absolutely need it. This is partially sound. You shouldn't apply frivolously or frequently, but the underlying implication, that you should have as few accounts as possible, works against the credit mix factor and the total available credit factor simultaneously. People with excellent scores typically have more accounts, not fewer, because more accounts mean more available credit, better mix, and a longer history. The advice to minimize credit engagement is protective of people who genuinely can't manage credit responsibly, but it's counterproductive for people who can. Pay off your credit card in full every month. This is genuinely good advice for avoiding interest charges, but it's presented as the credit optimal behavior when it's actually suboptimal from a pure scoring perspective, because paying in full after the statement closes still results in the full statement balance being reported. Paying before the statement closes, as we discussed, produces lower reported utilization. The distinction matters and is never explained in standard bank materials. A good credit score is 700 or above. This threshold is arbitrary and convenient. In practice, the most favorable rate tiers at most lenders begin at 720 or 740, and the best rates typically require 760 or above. Telling you that 700 is good keeps you satisfied with a score that is still paying a meaningful rate premium compared to where the genuinely best rates begin. It's not a lie, it's just a definition that happens to leave money on the table if you stop optimizing at 700. The insurance angle nobody warns you about. Here's a credit score application that surprises most people. In most states, your credit score, or a credit-based insurance score derived from similar data, is used to set your homeowners and auto insurance premiums. Credit-based insurance scores are not identical to FICO scores, but they use the same underlying credit report data and are heavily correlated. The stated rationale from insurers is actuarial. Credit data is statistically predictive of insurance claim frequency. Insurers have presented data suggesting that people with lower credit scores file claims more frequently. The practice is legal in most states. California, Hawaii, Massachusetts, and Michigan are notable exceptions that prohibit or restrict it. The impact can be substantial. Studies have found that drivers with poor credit can pay 50% to 100% more for auto insurance than drivers with excellent credit, controlling for driving record and other factors. Homeowners with poor credit can pay significantly more for homeowners insurance. These are ongoing recurring costs that most people don't connect to their credit score because the connection is never prominently disclosed. The optimization implication: improving your credit score doesn't just help you when you're applying for a loan. It reduces your ongoing insurance costs. Every point of improvement has a financial effect that extends across multiple cost categories simultaneously, which amplifies the return on the effort invested in credit optimization beyond what most people realize. Chapter 5: The Credit Card Strategies That Move the Needle. Fast credit cards are the most powerful tool available for credit score optimization. They're also the most dangerous tool available for personal finances if used carelessly. Both things are true simultaneously, and the way to navigate that duality is to understand exactly how credit cards affect your score, use them strategically for scoring purposes, and maintain the behavioral discipline that prevents the tool from becoming a liability. This chapter is about the specific credit card strategies, legal, specific, immediately actionable, that produce the fastest and most significant credit score improvements available to most people. The statement date payment strategy. Full mechanics. We've introduced this concept twice now. Here's the complete operational breakdown. Your credit card billing cycle typically runs approximately 30 days. At the end of the billing cycle, your statement is generated. This is the statement closing date. Your statement balance on that date is what gets reported to the credit bureaus. Approximately 21 to 25 days after the statement closes, your payment is due. This is the payment due date. Standard consumer behavior: spend throughout the month, statement closes with the accumulated balance, pay the balance by the due date. The reported balance is the full month spending. If you spent $1,500 on a card with a $5,000 limit, your reported utilization is 30%. Optimize behavior: spend throughout the month, identify your statement closing date, it's in your account settings or on your statement. Pay down the balance to near zero a few days before the statement closes. Statement closes with a minimal balance, say $50. That $50 is what gets reported. Your utilization on that card is 1%. You then pay the remaining $50 by the due date. To execute this, you need to know your statement closing date, log into your credit card account, find the billing cycle information, and note when the cycle ends. Set a calendar reminder a few days before that date. Pay down the balance before that reminder fires. For people with multiple cards, this strategy gets slightly more complex but also more powerful. You're managing the statement closing dates across multiple cards, aiming for each card to report a low or minimal balance. The aggregate effect on your overall utilization, which is calculated across all revolving accounts, can be dramatic. One practical challenge: this strategy requires having the cash available to pay the balance before the statement closes, rather than after. If your cash flow is tight and you're spending up to your paycheck cycle, paying before the statement date may mean paying from cash you haven't received yet, which isn't possible. In that case, a partial strategy, paying down as much as possible before the statement date, even if not to near zero, still produces some benefit. The multiple card utilization distribution strategy. Here's a strategy that most people instinctively do the opposite of. Spreading spending across multiple cards to keep individual card utilization low is better for your score than concentrating spending on one card, even if the total spending is identical. Why? The scoring model calculates utilization both in aggregate, all balances divided by all limits, and at the individual card level. A card with very high individual utilization hurts your score even if your aggregate utilization is moderate. By distributing the same total spending across several cards, each card's individual utilization stays lower, and the scoring effect is better than concentrating spending. Practical example: you have 3 credit cards, each with a $5,000 limit. Total available credit, $15,000. You spend $3,000 per month on credit cards. Option A: put all $3,000 on one card. That card's utilization, 60%. Aggregate utilization, 20%. The 60% on the single card is damaging your score even though the aggregate looks fine. Option B: spread the $3,000 evenly across 3 cards, $1,000 each. Each card's utilization, 20%. Aggregate utilization, 20%. Same aggregate, but no single card with damaging high utilization. Option C: combine this with the statement date payment strategy, paying down each card before it closes. Each card reports near zero utilization. Aggregate utilization, near zero. Score benefit, significant. The caveat: managing multiple cards requires organization. Missed payments on any card hurt the payment history factor, which is the most heavily weighted factor in your score. The strategy only works if you're tracking due dates and payment amounts across all cards. Automation, setting up auto pay for at least the minimum payment on every card, is essential to prevent accidentally missing a payment while executing a multi-card strategy. Requesting credit limit increases, the full playbook. Credit limit increases are available to almost any cardholder with a reasonable payment history, and most people never request them. Here's the complete playbook. When to request: after 6 to 12 months of on-time payments with a given card issuer. Earlier than 6 months is generally too soon. Issuers want to see an established payment pattern before extending more credit. Annually is a reasonable frequency for subsequent requests. How to request: online through the card's account portal, often the fastest method, through the mobile app if the issuer supports it, or by calling the number on the back of the card. The request will ask you to confirm or update your income and housing information. What determines approval? Your payment history with that issuer, your credit score at the time of the request, your reported income relative to your current limit, how long you've had the card, and the issuer's current credit appetite. Some issuers tighten limits during economic uncertainty. Whether it triggers a hard inquiry: this varies by issuer and sometimes by the size of the requested increase. American Express, for example, typically uses a soft pull for limit increase requests. Chase may use either, depending on the request. Discover typically uses a soft pull. You can often find the specific policy by calling and asking before submitting the formal request. A representative can usually tell you whether the increase request will trigger a hard inquiry. The income reporting factor is important and often underutilized. If your income has increased since you opened the card and you haven't updated it with the issuer, doing so when you request a limit increase can support a larger approval. Card issuers care about your income relative to your credit limit because it indicates your capacity to manage the credit responsibly. Higher reported income supports higher limits. The product change strategy. Here's one of the most underused strategies in credit card management: the product change, also called a card upgrade or downgrade. This is when you ask your card issuer to convert your existing card to a different product within their lineup, without opening a new account or closing the old one. Why this matters for credit scores: a product change preserves the account history, the account age, and the credit limit of the existing account while changing the specific card product, the reward structure, the annual fee, the benefits package, no new hard inquiry, no new account, no age reset. The account continues as if nothing changed, just under a different card product name. This is particularly useful in two situations. First, when you have a card with an annual fee that you want to eliminate without closing the account, which would hurt your score by reducing available credit and potentially affecting average account age. You can request a product change to a no-fee version of the same card, keeping the account alive without paying the annual fee. Second, when a newer card from the same issuer has better rewards or benefits, and you want to switch, doing so through a product change rather than closing and opening preserves the credit file value of the existing account. Not all issuers offer product changes, and the options vary by issuer. Call the number on the back of your card and ask what product change options are available within their lineup. Most major issuers have a range of cards and will accommodate product changes for customers in good standing. The authorized user play, detailed mechanics. We covered authorized users conceptually in Chapter 3. Here's the practical execution for people on both sides of the strategy. If you're the person being added, the primary account holder should add you through their card issuer's online portal or by calling customer service. They'll need your name and typically your date of birth. Some issuers also require a social security number to report the account to your credit file, which is necessary for the strategy to work. Ask the primary holder to confirm with their issuer that authorized users are reported to all 3 credit bureaus. Not all issuers report authorized users, most major ones do. Once added, the account will typically appear on your credit report within 1 to 2 billing cycles. The history that appears includes the account's age, the credit limit, and the payment history. The full record, not just from the date you were added. This is what makes an old account with a long, perfect history so valuable as an authorized user relationship. If you're the primary account holder adding someone, Your credit is not directly affected by adding an authorized user. The account remains on your report as your account. The authorized user's credit activity doesn't affect your score. The only risk is if you give the authorized user a physical card and they use it irresponsibly, but the strategy doesn't require giving them the physical card at all. The limits of this strategy: FICO's newer scoring models have become somewhat better at identifying authorized user relationships that appear artificial, especially rent-a-trade line situations where strangers pay to be added to unrelated accounts. Family relationships are more likely to be treated normally by the scoring model. And even in family situations, the impact of an authorized user account varies depending on the overall composition of your credit file. If your file already has old accounts and good utilization, an additional authorized user account adds less marginal benefit. The secured card upgrade path for people building credit from a thin file or rebuilding after significant credit damage, secured credit cards are often the first tool available. A secured card requires a cash deposit that becomes your credit limit. You deposit $500, you get a $500 credit limit. The deposit protects the issuer from default risk, which is why they're willing to issue cards to people with no credit or damaged credit. The strategy with secured cards is to use them as a temporary tool, not a permanent status. Here's the upgrade path. Step 1. Open a secured card with an issuer that reports to all 3 credit bureaus. This is not universal, so verify before opening. Also look for issuers with a clear upgrade path to an unsecured card. Step 2. Use the card minimally. 1 small purchase per month is sufficient, and pay in full before the statement closes, keeping reported utilization near 0. Step 3. After 6 to 12 months of clean payment history, request an upgrade to an unsecured card from the same issuer. Many issuers, Discover, Capital One, and others, have explicit secured to unsecured upgrade programs. When you upgrade, the account transitions to unsecured status, your deposit is returned, and the account history is preserved. This is the fastest path to a card with a real credit limit and a growing history. Step 4. Simultaneously or shortly after, apply for a second card from a different issuer to begin diversifying your credit file. Having at least 2 active revolving accounts is significantly better than one from a scoring perspective. The mistake most people make with secured cards, depositing the minimum amount allowed, $200, is common, and leaving it there indefinitely. A $200 credit limit, even at low utilization, contributes very little to your total available credit. If your budget allows, depositing a larger amount, $500, $1,000, or whatever the issuer's maximum allows, gives you a higher limit, which contributes more meaningfully to your credit profile and demonstrates a higher credit limit that carries forward when the card upgrades to unsecured. The introductory APR window strategy. 0% introductory APR offers on credit cards, typically offered for 12 to 21 months on purchases, balance transfers, or both, have a credit score dimension that goes beyond the obvious interest savings. When you open a card with a 0% introductory period and a generous credit limit, you immediately gain a significant amount of available credit. If you carry a balance on the card during the introductory period at 0 interest, your utilization increases on that card. But if the new card's credit limit is large and the balance you're carrying is moderate, the net effect on aggregate utilization may be positive. The new credit limit is large enough that even with a balance, your overall utilization improves. This is the intersection of the balance transfer strategy and credit optimization. Opening a balance transfer card with a large limit, transferring a high utilization balance from an old card, and having the transferred amount represent low utilization on the new card, due to the new card's higher limit, simultaneously reduces the old card's utilization to 0, adds a new high-limit card to your available credit pool, and may reduce aggregate utilization meaningfully. The critical discipline: paying off the transferred balance before the introductory period ends, because the deferred interest or standard rate that kicks in afterward can be punishing. This is a strategy for people who are organized and can commit to the payoff timeline, not for people who are managing unstable cash flow. Piggybacking business credit. Here's one final strategy in this chapter that applies to people who are self-employed, freelancing, or running any kind of business, however small. Business credit cards are a separate credit ecosystem from personal credit, and building both simultaneously creates financial flexibility that most people don't think about. Business credit cards typically don't appear on your personal credit report, They're reported to business credit bureaus, primarily Dun & Bradstreet, Experian Business, and Equifax Business, rather than personal ones. This means you can carry business expenses on a business card without affecting your personal credit utilization. For self-employed people who run significant business expenses through credit cards, this is a meaningful distinction. Those business expenses aren't inflating your personal utilization ratio. Additionally, building a business credit profile creates access to business financing, lines of credit, equipment loans, SBA loans, that operates largely independently of your personal credit. Building both simultaneously gives you more total available credit, more flexibility, and more financial resilience than personal credit alone. The starting point for business credit is simpler than most people think. You don't need a corporation or an LLC. A sole proprietorship, which is the default structure when you're self-employed without any formal entity, can apply for an EIN, Employer Identification Number, from the IRS for free, open a business bank account, and apply for business credit cards. The first business cards you'll likely qualify for will require a personal guarantee, meaning your personal credit is part of the approval decision. But as your business credit history grows, you can access business credit that stands independently. Chapter 6. The mistakes that are silently destroying your score. Right now, here's the uncomfortable part of the credit score conversation. The part where we stop talking about what you could be doing and start talking about what you might already be doing wrong, not to make you feel bad, to make you feel informed. Because the mistakes in this chapter are remarkably common, remarkably damaging, and remarkably invisible until you know what to look for. The most insidious credit mistakes are not the obvious ones. Most people know that missing payments is bad. Most people know that maxing out a credit card is bad. What most people don't know are the subtler errors, the things that seem neutral or even responsible on the surface but are quietly suppressing their score month after month, costing them money on every loan they take out without them ever connecting the cause to the effect. Let's go through them in order of how commonly they're made and how badly they damage scores. Mistake number 1, closing old credit cards. This is the single most common credit mistake, made by financially responsible people, and it's made with the best intentions. You pay off a credit card, you're proud of yourself, you decide you don't want the temptation of an open line of credit, you call and close the account. Responsible behavior, right? Wrong, or at least wrong from a credit score perspective. Closing a credit card hurts your score in 2 simultaneous ways. First, it reduces your total available revolving credit, which increases your credit utilization ratio across all remaining cards. If you had $20,000 in total credit limits across 4 cards and you close one with a $5,000 limit, your total available credit drops to $15,000. If you're carrying $4,000 in balances across your remaining cards, your utilization just jumped from 20% to 27% without you spending a single additional dollar. Second, it affects the length of your credit history. While closed accounts in good standing do remain on your credit report for up to 10 years, meaning the history isn't immediately erased, the account eventually disappears, and when it does, the average age of your accounts can drop significantly. An account you opened 15 years ago and closed today will help your average age calculation for another decade, but when it finally falls off, the impact on your average account age can be substantial. The alternative, keep old cards open. Put a small recurring charge on them, a streaming subscription, a utility bill, and set up autopay for the full balance. The card stays active, the history continues to build, the credit limit continues to contribute to your available credit, and you're not paying interest on anything. The card is doing its credit building job with zero effort from you. The only legitimate reasons to close a card, it has an annual fee you can't justify, and the issuer won't downgrade it to a no-fee product. Even then, consider whether the annual fee is worth paying specifically to preserve the credit history and for a very old card with a very high limit. The math sometimes says yes. Mistake number 2, applying for multiple credit cards in a short period. We established that mortgage rate shopping, multiple mortgage inquiries in a short window, is treated as a single inquiry by the scoring model. Credit card applications do not receive the same treatment. Each credit card application generates a separate hard inquiry that is counted independently. The mistake, applying for several credit cards in quick succession, either because you're trying to build credit fast or because you're chasing multiple sign-up bonuses simultaneously. The immediate effect is multiple hard inquiries, a meaningful temporary score drop, and a reduction in average account age from multiple new accounts opening simultaneously. The compounding effect. Lenders see multiple recent inquiries on your credit report as a potential signal of financial stress, the interpretation being that someone seeking a lot of new credit quickly may be doing so out of desperation. Whether or not that interpretation is fair, it affects both scoring and manual underwriting decisions. The right pace, 1 to 2 new credit cards per year, is generally considered reasonable for credit building purposes. More than that in a 12-month period starts to produce diminishing returns as the inquiry and new account effects accumulate faster than the available credit benefits build up. The sign-up bonus consideration: if you're pursuing credit card rewards strategically, opening cards for sign-up bonuses and then downgrading or closing them, space the applications by at least 3 to 6 months, and be aware of issuers who have their own application velocity rules. Chase, for example, has an informal 524 rule. They typically won't approve new applicants who have opened 5 or more credit cards across any issuers in the past 24 months. Knowing these issuer-specific rules before applying prevents wasted hard inquiries on applications that were unlikely to be approved. Mistake number 3, carrying a balance to build credit. This is a myth so pervasive and so persistent that it deserves its own dedicated debunking. The myth: you need to carry a balance on your credit card, pay interest, in order to build credit or improve your score. Pay it off completely every month, and the card doesn't count for credit building purposes. This is completely false, and believing it is costing people real money in unnecessary interest charges. What actually builds credit is having the account open and active, meaning it's being used and reported to the credit bureaus with a history of on-time payments. Whether you pay the balance in full or carry a portion of it forward is irrelevant to the payment history factor, which is 35% of your score. What matters is that the payment is made on time, not that a balance is maintained. In fact, as we've established extensively in this video, carrying a balance increases your utilization ratio, which hurts the amounts owed factor, 30% of your score. The optimal behavior for credit scoring purposes is to use the card, pay it in full before the statement closes to minimize reported utilization, and never pay $1 of interest to the card issuer. The card reports perfectly positive information to the bureaus. You pay 0 interest. The myth that carrying a balance helps your credit is not just wrong, it's wrong in the direction that benefits the card issuer, which should tell you something about where the myth likely originated. Mistake number 4. Ignoring your credit report until something goes wrong. The average American checks their credit report less than once a year. Given that approximately 1 in 5 credit reports contains an error, and given that identity theft often goes undetected for months, this means that a significant percentage of people are operating with inaccurate credit information for extended periods, paying higher interest rates, being declined for credit, or having their financial identity compromised without knowing it. The errors that go undetected longest are the subtle ones. A balance reported higher than it actually is, a payment marked 30 days late when it was on time, an account that was closed years ago still showing as open, a collection account that doesn't belong to you because it was assigned to the wrong person with a similar name. These errors don't trigger obvious alerts. They just sit there, depressing your score month after month until you look. The monitoring cadence that makes sense: check all 3 credit reports, Equifax, Experian, and TransUnion, at least once per year through annualcreditreport.com. Consider staggering the checks throughout the year, pulling one bureau every 4 months, rather than pulling all 3 at once, so you have more frequent windows to catch errors and signs of fraud. Sign up for free. Credit monitoring through at least one service that provides real-time alerts for significant changes, new accounts, hard inquiries, large balance changes. The alerts don't prevent problems, but they surface them quickly enough to limit damage. Mistake number 5. Letting accounts go to collections, including unexpected ones. This seems obvious. Don't let bills go to collections until you consider the specific categories of debt that send people to collections without them fully realizing it's happening. Medical debt is the most common surprise collection account. You received care, the insurance paid a portion, the remaining balance went to a billing department, the billing department sent statements to an address that may have changed, the statements went unresponded to, and 6 months later a collection account appears on your credit report for a $200 copay you didn't know was still outstanding. Medical billing processes are notoriously convoluted, and medical collection accounts are strikingly common even among people who are otherwise financially responsible. Utility bills from old addresses, electricity, gas, water, cable are another common source of surprise collections. When you move, final bills are sent to your old address. If they're not forwarded or if the forwarding period expires before the bill is processed, you may never see the bill and may not discover the collection until you pull your credit report. Library fines, parking tickets, and similar small municipal obligations can go to collections in some jurisdictions. Gym memberships with cancellation periods that you thought you'd ended properly, storage unit balances. These are small dollar amounts that can have disproportionate credit impacts because any collection account, regardless of the amount, is a significant derogatory mark. The defense: when you move, don't just set up mail forwarding. Actively update your address with every creditor and biller you can. Identify, including utilities, insurance, and any service providers. Monitor your credit report for new collection accounts that appear unexpectedly. And if you receive medical care, follow up with both the provider and your insurance company to confirm what you owe and pay it promptly. The FICIO 9 and VantageScore 4.0 models treat medical collections more leniently than older models, and there have been recent changes by the major bureaus to remove certain medical debt from credit reports. But until you know which model your specific lender is using, you can't assume medical collections are being ignored. The safest approach is to prevent them from appearing in the first place. Mistake number 6. Co-signing loans without understanding what you're taking on. Co-signing a loan for someone, a family member's car, a child's private student loan, a friend's apartment lease, means that loan appears on your credit report as if it were your own. The primary borrower's payment behavior directly affects your credit score. If they pay on time, it helps you. If they pay late, it hurts you. If they stop paying entirely and the loan defaults, you are legally responsible for the debt, and the default appears on your credit report as if you defaulted on your own loan. This is a risk that many co-signers don't fully internalize at the time of signing. The request comes from someone you care about. The immediate emotional dynamic makes saying no difficult, and the long-term credit implications feel abstract. They become very concrete the first time a late payment notification appears on your credit report for a loan you haven't thought about in 2 years. Co-signing isn't always wrong. Sometimes it's a genuine act of support that helps someone access credit they need and that they manage responsibly. But it should be entered with full understanding that you are, for credit reporting purposes, fully responsible for that debt. If you're not comfortable with that loan appearing on your credit report under your name indefinitely, don't co-sign. If you've already co-signed and the primary borrower has been making payments, you're building payment history. If the primary borrower has been struggling, explore whether refinancing in their name alone is possible once their credit improves, removing you from the loan and its associated reporting. Mistake number 7. Not understanding the difference between soft and hard inquiries. We've touched on this, but it generates enough confusion to warrant direct treatment. People sometimes avoid checking their own credit because they're afraid it will hurt their score. It won't. Checking your own credit is a soft inquiry, which has zero effect on your score. Lenders checking your credit as part of an application is a hard inquiry, which has a small, temporary effect. The confusion causes real harm. People who are afraid to check their credit go longer without detecting errors, without tracking their score, trajectory, and without the information needed to make good credit decisions. The fear of damaging their score by looking at it causes them to make worse decisions than they would with current, accurate information. Check your credit as often as you want. Use free monitoring services. Pull your full reports annually. None of it affects your score. The only inquiries that affect your score are the ones initiated by lenders during application processes, and even those, as we've established, have small, temporary effects that are usually outweighed by the benefit of the credit product you're applying for. Mistake number 8. Settling debts for less than the full amount. Without understanding the consequences. If you're dealing with a past due account and a collector offers to settle for less than the full balance, will take $1,500 to satisfy the $3,000 balance, the offer can feel like a financial lifeline. and sometimes it is, but the credit reporting consequences of a settled account are worse than most people realize. A settled account, one where you paid less than the full balance, is reported to the credit bureaus as settled or settled for less than full amount. This notation is a negative mark. It's better than an unpaid collection, but it's worse than paid in full, and it remains on your credit report for 7 years from the original delinquency date. The negotiating move most people don't know about: pay for delete. Before settling any collection account, attempt to negotiate a pay for delete agreement. The collector agrees in writing that upon payment, they will request deletion of the account from your credit report entirely, not settled notation, full removal. Pay for delete is not guaranteed. The Fair Credit Reporting Act technically doesn't require collectors to delete accurate information simply because you've paid, but many collectors, particularly smaller ones, will agree to it because their primary goal is recovering money, not reporting accurately to credit bureaus, get any pay for delete agreement in writing before making payment. Verbal agreements in debt collection are worth approximately nothing. The written agreement is your leverage for following up if the deletion doesn't happen. Even without pay for delete, paying a collection account improves your situation under FISO 9 and Vantage Score models that ignore paid collections. Under older models like FISO 8, a paid collection still carries negative weight, though less than an unpaid one. Know which model your likely future lenders use before deciding whether paying an old collection without a deletion agreement is worth the effort. Chapter 7: Building Credit from Nothing. The fastest legitimate path. Let's say you're starting from zero. No credit history, no credit cards, no loans. Maybe you're a young adult just entering the financial system. Maybe you're a recent immigrant establishing credit in a new country. Maybe you went through a period of avoiding all debt and now have a thin file that produces a low score despite having done nothing actively wrong. Whatever the reason, you're at the beginning and you need to build. The good news: building from zero, while frustrating, is actually easier in some ways than rebuilding from significant damage. You're not fighting negative items, you're just adding positive ones. And the fastest legitimate path from no credit to a good score is shorter than most people realize. Typically 12 to 24 months if you execute the right moves in the right order. Here's the fastest legitimate path, step by step. Step 1. Check whether you have any credit history you don't know about. Before assuming you have no credit history, verify it. Pull your reports from all 3 bureaus at annualcreditreport.com. Some people who believe they have no credit actually have thin files, 1 or 2 accounts they opened years ago that they've forgotten about. Others have errors or fraudulent accounts they didn't know existed. A small percentage of people have credit history from authorized user relationships they were added to without realizing the full implication. Know what you're actually working with before deciding what to build. Step 2. Open a secured credit card. The secured credit card is the standard entry point for credit building, and for good reason. Almost anyone can qualify because the deposit eliminates the lender's risk. Choose your secured card carefully. Criteria to evaluate. Reports to all 3 credit bureaus. This is non-negotiable. A secured card that only reports to 1 or 2 bureaus is building credit in an incomplete way. Confirm before opening. Has a clear upgrade path to an unsecured card. Discover it secured. Capital One Platinum secured, and several others have explicit upgrade programs that convert your account to unsecured after a period of good behavior, typically 6 to 12 months. When the account upgrades, your deposit is returned and the account history is preserved. Has no or low annual fee. Some secured cards charge annual fees of $35 to $75. These fees are worth avoiding when alternatives exist, since the primary purpose of the card is to build history, not to provide benefits. Allows a higher deposit for a higher limit. Depositing $500 or $1,000 instead of the minimum $200 gives you a higher credit limit, which contributes more meaningfully to your available credit calculation and makes keeping utilization low easier. Step 3. Use the card minimally and pay before the statement closes. Put one small recurring charge on the secured card, a streaming service, a phone bill, anything you'd pay anyway. Set up autopay for the full balance. Pay the balance down to near zero a few days before the statement closing date each month. The card reports on-time payment activity, low utilization, and growing account age. You're paying no interest, spending no extra money, and building credit history automatically. Do not use the secured card for significant discretionary purchases in the early months. The deposit is typically equal to your credit limit, and carrying a meaningful balance on a card where your limit equals your deposit means you've effectively locked up the deposit while also running high utilization. Use it minimally, report low, keep the history clean. Step 4. Add a credit builder loan. A credit builder loan is a financial product specifically designed for credit building, offered by many credit unions, community banks, and some online lenders. The mechanics are the opposite of a traditional loan. Instead of receiving money upfront and paying it back, you make monthly payments into a secured account, and at the end of the loan term, you receive the accumulated funds. The credit benefit: the monthly payments are reported to the credit bureaus as installment loan payments, adding a different credit account type to your file, improving credit mix, and adding more on-time payment history. At the end of the term, typically 12 to 24 months, you receive the money you paid in, minus any fees and interest, essentially functioning as a forced savings account that also builds credit. Self Financial is the most prominent online credit builder loan provider and is widely accessible. Many credit unions offer similar products to members. The cost is modest, typically $12 to $25 per month in fees, and the credit benefit of adding an installment account to a thin file can be significant, sometimes 15 to 25 additional points. Step 5. Become an authorized user on a strong account. As detailed in Chapter 3, being added as an authorized user on a family member's or trusted friend's old, high-limit, perfect history credit card can instantly add years of positive history to your thin file. This step has the potential to be the single largest single-action score. Improvement available during the building phase. The sequencing matters. If you can become an authorized user before opening your own accounts, the length of credit history you immediately have on file is longer from the start, which means your average account age doesn't start at zero. Opening your own accounts after being added as an authorized user means your average age calculation already has a longer account in it, softening the age reduction from new accounts. If you don't have a family member or trusted friend willing to add you, this step is simply unavailable to you. The rent-a-trade line services are not worth the ethical ambiguity, and the risk that newer scoring models will discount the relationship as artificial. Move forward without this step if it's not accessible. Step 6. Apply for a second card after 6 to 12 months. After 6 to 12 months of clean payment history on your secured card, you should have enough credit history to apply for a basic, unsecured credit card. At this stage, you're not necessarily aiming for the best rewards card on the market. You're aiming for a card with a higher credit limit than your secured card that you can manage responsibly, adding more available credit and another positive account to your file. The second card increases your total available credit, which reduces your utilization ratio. It adds another account to your mix. It begins building a second payment history, and it demonstrates to the scoring model that multiple lenders have evaluated you and found you creditworthy, which is part of what the amounts owed factor is measuring when it looks at how many accounts have balances. Step 7. Request the secured card upgrade around the 12-month mark. If you've been executing the strategy, your secured card issuer should be receptive to upgrading your account to unsecured. Contact them directly and request the upgrade. They'll review your payment history with them, which at this point should be 12 months of on-time payments, and make a decision. When the account upgrades, your deposit is returned, sometimes immediately, sometimes over a billing cycle, and the account continues with a new unsecured credit limit that's often equal to or higher than your deposit. The account history, the account age, and the payment record all carry forward intact. At this point, you have a now unsecured card with 12+ months of history, a second card with 6+ months of history, a credit builder loan reporting installment payments, and possibly an authorized user account with years of history. Your credit file has transformed from thin to substantive. Your score, which may have started around 580 to 620 with minimal history or not been scoreable at all, should be approaching or exceeding 700, possibly significantly higher depending on the specific accounts and their characteristics. What the timeline looks like. Month 0. open secured card, potentially become authorized user on family account. Month 1 to 3, credit builder loan opens, 2 accounts reporting, score may be in 580 to 630 range as history establishes. Month 6, apply for second credit card once secured card has 6 months of history, score approaching 650 to 680 as payment history builds. Month 12, request secured card upgrade, score in 680 to 720 range with clean history across multiple accounts. Month 18 to 24, all accounts maturing, average age growing, utilization consistently low, score in 720 to 760 range or higher, depending on credit limit growth and continued clean history. This is not a guaranteed timeline. Individual results vary based on specific account characteristics, starting conditions, and factors outside your control, but it represents what's achievable for most people who execute the strategy consistently. Chapter 8. The Advanced Moves. What people with 800 plus scores actually do. Here's the thing about people with credit scores above 800. They're not doing anything magical. They're not exploiting secret loopholes. They don't have special relationships with the credit bureaus or insider access to better scoring information. What they have is time, consistency, and a set of habits that have compounded over years into a credit profile that the scoring model finds virtually perfect. But they also know specific things, specific behaviors, and specific decisions that people in the 680 to 740 range often don't, and those specific things are what separate a good score from an excellent one. This chapter is those things. The 800 plus profile, what it actually looks like. People with scores above 800 share a remarkably consistent credit profile. Understanding the profile helps you understand what you're building toward and what the scoring model considers ideal. Average age of accounts, typically 7 years or more. This is not achievable quickly. It requires either a long history or a combination of old accounts and strategic avoidance of too many new ones. Number of accounts, typically 6 to 15 open accounts, including a mix of revolving and installment credit. Not an enormous number, but more than the 1 or 2 accounts that constitute a thin file. Utilization, consistently below 10% on both aggregate and individual accounts. Not always. There are months where spending runs higher, but the pattern over time is low utilization. Payment history, perfect or very close to it. A single late payment is not necessarily disqualifying at 800 plus, but it's rare. The record is typically years of unbroken on-time payments. Hard inquiries, minimal. People with 800 plus scores are not frequently applying for new credit. They apply deliberately, space applications thoughtfully, and don't chase opportunities that generate inquiries without commensurate benefit. Negative items, none, or nothing recent. Any negative history from the distant past has either fallen off the report or has been so thoroughly buried by subsequent positive history that its impact is negligible. The patient accumulation strategy. The most powerful thing people with 800 plus scores do is something that cannot be rushed. They accumulate time. Every month that passes with clean payment history, every year that accounts age without negative marks, every incremental increase in credit limit, all of it compounds in a way that produces a profile the scoring model treats as extremely low risk. The implication is that the people with the highest scores are not necessarily the people who've been the most strategically sophisticated. They're often just the people who've been managing credit responsibly for the longest time without significant disruptions. A 55-year-old with decades of clean history and old accounts has structural advantages over a 30-year-old with a perfect recent record simply because of account age. This doesn't mean younger people can't achieve 800-plus scores. They can, and some do. In their late 20s or early 30s with good habits and strategic account management, but it does mean that some of the work of achieving and maintaining very high scores is simply showing up consistently over time, which is boring and important and overlooked. The credit limit maximization approach. People with 800 plus scores have typically maximized their credit limits across their accounts over time, not by spending more, but by requesting increases regularly and accepting them when automatically offered. The result is a total available credit pool that makes their actual spending represent a tiny fraction of available credit, producing consistently excellent utilization numbers. If you're spending $2,000 per month on credit cards and your total available credit is $8,000, your maximum potential utilization is 25%. If your total available credit is $40,000, your maximum potential utilization is 5%. Same spending, completely different utilization profile. The advanced move. Every 12 to 18 months, systematically request limit increases on every card you hold. Keep a simple record of which cards you've requested increases on and when. Most issuers will grant some increase to customers with clean payment history, and over the years, the cumulative effect of regular limit increases is a significantly larger credit pool relative to your spending. The garden strategy. In credit card enthusiast communities, there's a concept called gardening, the practice of letting your credit account sit quietly and grow without opening new ones, allowing account ages to mature, inquiries to age off, and the credit profile to settle into a stable, high-scoring state. Gardening is what people with 800-plus scores implicitly do. After building a solid base of accounts, they stop aggressively adding new ones and simply maintain what they have, using cards regularly enough to keep them active, paying on time, keeping utilization low, and allowing time to do the work. The score climbs steadily not because of new strategic moves, but because account ages are increasing, inquiries are aging off, and the clean payment history is lengthening. The mistake people make in the 720 to 760 range, continuing to pursue new accounts, new rewards, new credit products, when what the score most needs is stability and time. The marginal benefit of a new account at 750 is much smaller than the marginal benefit of 6 more months of aging existing accounts. Gardening, deliberately pausing new account applications for 12 to 24 months, is often the most effective move available to someone in the 740 to 780 range trying to break through to 800 plus. The annual credit card audit people with excellent credit treat their credit card portfolio like an investment portfolio, reviewing it periodically, optimizing it for current goals, and making deliberate changes rather than letting it drift. An annual credit card audit involves reviewing every card you hold and asking a set of questions. Is this card earning enough value in rewards, benefits, or credit building to justify its annual fee, if any? Has my spending pattern changed such that a different card would better fit my habits? Is this card's credit limit still competitive with what I could get from a new card? Has this issuer offered a product change opportunity that would improve my terms without affecting my credit history? The audit also involves confirming that all cards are being used at least occasionally. Most issuers reserve the right to close inactive accounts, which would hurt your score. A once-per-quarter small purchase on every card you hold keeps them active without requiring you to think about them constantly. Freezing your credit when you're not using it. This is a security practice that people with excellent credit use routinely, and most other people don't know about. You can freeze your credit file at all 3 bureaus, Equifax, Experian, and TransUnion, for free. A freeze prevents any new hard inquiries from being processed, which means no new credit can be opened in your name without you first unfreezing the file. The benefit: it's the most effective protection against new account identity theft, the type where someone opens credit cards, loans, or other accounts in your name using stolen personal information. With a freeze in place, a fraudster who has your social security number and personal information still cannot open credit accounts in your name because the inquiry will be blocked. The process: you freeze and unfreeze your file as needed through each bureau's website or by phone. Freezing is free. Unfreezing is free. The temporary unfreeze takes minutes and can be done precisely when you're applying for something legitimate, then refrozen immediately after. People who are not actively seeking new credit, which, for someone who's gardening and maintaining an 800-plus score, is most of the time, should have their credit frozen. The score is unaffected by a freeze. Monitoring still works. The only thing blocked is new applications, which is exactly the protection you want. The FICO 10T consideration. FICO 10T, one of the newest scoring models, introduces a concept called trended data that rewards a specific behavior that older models couldn't capture, consistently paying balances in full rather than carrying them forward. Older FICO models take a snapshot of your credit at a point in time. Your balance today is what gets evaluated. FICO 10T looks at your balance history over time, the trend of your balance relative to your credit limit across multiple months. A consumer who consistently shows declining or zero balances over time is scored more favorably than a consumer who occasionally shows the same balance at the moment of the snapshot. This means that people who genuinely pay their balances in full every month rather than just paying them down before the statement date on an occasional basis build a trending pattern that FICO 10T rewards additionally. It's not just about what your balance is right now, it's about the pattern your balance has shown over the past 24 months. FICO 10T is not yet universally adopted. Mortgage lenders are in the process of transitioning to newer models, and many lenders still use FICO 8. But awareness of trended data and the behavior it rewards, consistently paying in full, not carrying balances, is relevant for people building credit profiles that will be evaluated over the next several years as model adoption increases. Using credit as a tool, not a lifeline. Here's the most consistent characteristic of people with 800+ credit scores, the one that underpins everything else. They use credit as a tool that serves their financial life, not as a lifeline that substitutes for financial stability. Credit cards for these people are not a way to spend money they don't have. They're a way to earn rewards on money they would spend anyway, to smooth minor cash flow fluctuations, to access consumer protections and benefits that cash doesn't provide, and to maintain an active credit profile that keeps their score high. The debt is not real debt, in the sense of balances that are carried and interest that's paid. It's transactional debt that's retired every month before it costs anything. The credit score is a byproduct of this relationship with credit, not the goal of it. The 800+ score is what happens when someone who is genuinely financially stable uses credit tools strategically over a long period. The score reflects the underlying financial reality. This is the key reframe for credit score optimization at the highest level. The goal is not to score hack your way to 800 while the underlying financial situation remains fragile. The goal is to develop genuine financial stability, an income that exceeds expenses, savings that provide resilience, debt that is managed rather than accumulated, and then to use credit tools in ways that accurately reflect that stability. The score will follow. Chapter 9, The Credit Score, Myths That Won't Die, and Why They Keep Spreading. Every field has its folklore. Medicine has old wives' tales about feed a cold, starve a fever. Personal finance has the latte factor. And credit scores have an entire ecosystem of myths so persistent, so widely repeated, and so confidently delivered by people who should know better that they've essentially achieved the status of conventional wisdom, despite being wrong in ways that cost people real money. This chapter is a direct confrontation with the most damaging credit score myths still circulating in 2024, on social media, in bank lobbies, in well-meaning conversations between friends and family members who are passing along something they heard from someone who heard it from someone who read it in a magazine in 1997. Some of these myths are harmless. Most of them are not. And the reason they persist, the reason they keep getting repeated despite being demonstrably false, is worth understanding, because the mechanism that spreads bad financial information is the same mechanism that keeps people from finding good information. Myth number 1, checking your own credit score hurts. This is the granddaddy of credit myths, the one with the most staying power and the most real-world damage. People who believe this myth avoid checking their own credit, sometimes for years, out of fear of hurting the very score they're trying to protect. The result is that they go extended periods without detecting errors, without tracking their score trajectory, and without the information they'd need to make better credit decisions. The fact, checking your own credit score or credit report generates a soft inquiry, which has zero effect on your score. Zilch. Nothing. The scoring model does not penalize you for being informed about your own credit situation. The distinction that matters, soft inquiries versus hard inquiries. Soft inquiries, which include your own checks, pre-approval screenings by lenders, and background checks by employers, are invisible to the scoring model. Hard inquiries, on which happen when you formally apply for credit, have a small temporary effect. Checking your own score is always a soft inquiry. Always. There is no scenario in which pulling your own credit report through a legitimate monitoring service generates a hard inquiry. Why does this myth persist? Partly because the word inquiry appears in the context of both soft and hard pulls, creating a conflation that's easy to make and hard to undo once it's established. partly because financial anxiety is a real phenomenon, and people who are anxious about their credit sometimes assign agency to actions that feel risky even when they're not, and partly because the myth is spread by people who genuinely believe it and are trying to be helpful, which is the most effective vector for false information. The corrective behavior: check your credit score and credit reports frequently. Monthly tracking through a free monitoring service is not excessive. Annual review of all 3 full credit reports is the minimum. The information you gain from checking protects your score far more than avoiding the check ever could. Myth number 2, income affects your credit score. This one is almost the opposite problem from the checking myth. Instead of causing people to avoid beneficial behavior, it causes people to assume their score is better protected than it is because they have a good income. The fact: your income is not a factor in your credit score calculation, not even slightly. FICO and VantageScore do not have access to your income information. Your credit report does not contain your salary. The scoring model is built entirely from credit behavior data, payment history, account balances, account ages, inquiries, account types, and income is simply not part of the dataset. This surprises people because income feels like it should matter. If you make more money, you're more capable of repaying debt, right? Logically, yes. But the scoring model doesn't measure capacity in income terms. It measures behavior in credit terms. A person making $300,000 a year with high utilization, a missed payment, and a thin file can have a lower credit score than a person making $45,000 a year with low utilization, perfect payment history, and a diverse account mix. The implications of this myth are significant. People with high incomes sometimes delay credit optimization because they assume their financial stability is reflected in their score. It isn't. And people with modest incomes sometimes assume their score is inherently limited by what they earn. It isn't either. Your credit score is a behavioral measurement. Behavior is what drives it. Income just determines what you can afford to do. That's true. Which matters a lot for financial health generally, but not at all for the specific 3-digit number we're discussing. Myth number 3, you need to be in debt to have a good credit score. We addressed the carried balance version of this myth in Chapter 6. But the broader version, the belief that owing money is a prerequisite for a good credit score, runs deeper and deserves its own treatment here. The myth manifests in different forms. Sometimes it's the carried balance belief: you need to leave some balance on your card to show you're using it. Sometimes it's a more general belief that having no debt means having no credit history, which means having no score. Sometimes it's the idea that paying off a loan hurts your score because you're removing credit from your profile. The fact, unpacked carefully, you need to have used credit to have a credit score. You do not need to be in debt, carrying balances, paying interest, owing money to have an excellent credit score. The distinction is between credit activity and credit debt. Credit activity means opening accounts, using them, and paying them off. Credit debt means carrying balances and paying interest. The scoring model rewards the former. It is indifferent to, and in the case of high utilization, actually penalized by, the latter. The loan payoff piece is worth addressing specifically because it confuses people. When you pay off an installment loan, a car loan, a student loan, a personal loan, the account closes and the positive payment history remains on your report, but the account moves to closed status. Your credit mix may temporarily narrow if it was your only installment account. Your total available credit doesn't change for installment accounts the way it does for revolving accounts. The net scoring effect of paying off an installment loan is usually slightly negative in the very short term, sometimes a few points, and neutral to positive over the medium term as the clean history continues to age positively. This temporary dip after paying off a loan has convinced many people that paying off loans hurts their credit score, leading to the perverse advice to maintain unnecessary debt for scoring purposes. The temporary dip is minor. The financial benefit of eliminating debt and the interest it generates is enormous. Pay off the loan. Myth number 4, marrying someone with bad credit ruins your credit. This myth causes genuine distress to people entering relationships where one partner has a stronger credit history than the other. The fear, your spouse's bad credit will contaminate your good credit simply by virtue of marriage. The fact, marriage does not merge credit files. You and your spouse each maintain completely separate credit reports and credit scores after marriage. Your spouse's delinquencies, collections, and low score have zero direct effect on your credit score as long as you do not share joint accounts. The nuance that makes this complicated in practice: joint accounts, credit cards, loans, or lines of credit that both of you apply for together, do appear on both credit reports and affect both scores. If your spouse has poor credit and you open a joint credit card together, that account's history affects you both. If you take out a joint mortgage together, both of you are responsible for the payment history. The joint account is the mechanism through which one partner's credit behavior affects the other's, not the marriage itself. The practical implication for couples with different credit scores: consider carefully which accounts to open jointly and which to maintain separately. For a mortgage, many couples in this situation apply with only the higher scoring partner as the borrower, accepting a potentially lower loan limit in exchange for a better interest rate. For credit cards, maintaining separate accounts means each partner's behavior affects only their own score. As the lower scoring partner builds their credit over time, joint accounts become less costly. Why these myths keep spreading and what you can do about it. The persistence of credit score myths isn't random. There's a structural reason why wrong information about credit scores spreads so effectively and why correct information struggles to displace it. Wrong information about credit scores tends to be simple, memorable, and emotionally resonant. Checking your credit hurts it is a clean, memorable rule that feels like it makes sense. Looking at something feels like it should have consequences. Income affects your score feels like it should be true because income and creditworthiness feel intuitively connected. These myths spread because they fit existing mental models easily. Correct information is often more complicated. Soft inquiries don't affect your score, but hard inquiries do, and here's the difference: is harder to remember and harder to pass along in a casual conversation than checking your credit hurts it. The truth has more moving parts than the myth, which gives the myth a virality advantage. The solution at the individual level is exactly what you're doing right now, going deeper than the casual conversation version of financial information, understanding the actual mechanics, and building mental models that are accurate enough to use as a basis for real decisions. The person who understands why a myth is wrong, not just that it's wrong, is far less likely to act on the myth or to spread it to others. Credit score literacy is not just personally valuable. Every person who understands how the system actually works is slightly less vulnerable to the financial products, the advice, and the institutional narratives that profit from widespread misunderstanding. That is not a small thing. The credit system affects nearly every significant financial transaction in your adult life. Understanding it fully, the mechanics, the strategies, the myths, the incentives on all sides, is one of the highest return investments of time and attention available in personal finance. You've made that investment by watching this far. Use what you've learned, check your report, manage your utilization, build your history deliberately, request those limit increases, dispute those errors, stop believing things that aren't true just because someone confident said them. Your score is yours, the system is learnable, and the financial difference between understanding it and not is, over the course of a lifetime, genuinely significant. Conclusion. Let's take stock of what we've covered because it's substantial, and the breadth of it reflects the fact that credit scores are genuinely complex, genuinely important, and genuinely underexplained by the institutions that benefit most from you not understanding them fully. We started by dismantling the official explanation, the sanitized, incomplete version of what credit scores are, and how they work. Credit scores are commercial products built by private companies sold to lenders, designed to predict a very specific probability. There is no single score. The data feeding into the scores is error-prone. The system was built for lenders, not for you. We went through the 5 scoring factors with the depth they deserve, not just naming them, but explaining the mechanics within them that most people never learn. Payment history is about severity and recency, not just presence. Utilization is about when your balance is reported, not just what you owe. Credit history length rewards patience and penalizes the closure of old accounts. New credit is manageable with the right timing and rate shopping protections. Credit mix improves naturally without engineering. We cataloged the specific legal strategies that move scores faster than standard advice suggests: the utilization timing play, the credit limit increase strategy, the authorized user mechanism, the rapid rescore process, the dispute pipeline, the balance transfer optimization. None of these are secret. All of them are available to anyone who understands the rules well enough to use them. We looked honestly at what your bank actually does with your score: the risk-based pricing machine, the minimum payment engineering, the advice that serves their interests while appearing to serve yours. The gap between institutional advice and genuinely optimal advice is real, and naming it is the first step to navigating around it. We went deep on credit card strategies that produce fast, real improvements: the statement date payment approach, the multi-card utilization distribution, the credit limit increase playbook, the product change mechanism, the secured card upgrade path. We cataloged the mistakes that silently suppress scores: closing old cards, applying for too many accounts too quickly, carrying balances unnecessarily, ignoring credit reports, co-signing without full, understanding settling debts without negotiating deletion. We built the fastest legitimate path from no credit to a good score: the secured card, the credit builder loan, the authorized user strategy, the second card, the upgrade, and the realistic timeline that connects them. And we described what 800 plus looks like and how to get there: patient accumulation, credit limit maximization, gardening, annual audits, credit freezing, and the foundational principle that a great credit score is ultimately a reflection of genuine financial health expressed through strategic credit management. Here's what I want you to take away from all of this, distilled to its essence. Your credit score is a game. It has rules. The rules are learnable. The game can be played well by anyone who understands the rules clearly enough to work within them strategically. The institutions that use your score have not been strongly incentivized to explain the rules to you, because their profitability is partly a function of how many people play the game poorly. Understanding the rules doesn't just improve a number, it saves you money. Real money. In every loan you take, every rate you're quoted, every insurance premium you pay, for the rest of your financial life. The difference between a 620 credit score and a 760 credit score is not the difference between a financially responsible person and a financially irresponsible one. It's often the difference between someone who understood the game and someone who didn't. You now understand the game. Play it well.